Welcome to the December housing market update from CoreLogic RP Data. As we move into the final month of the year, it looks as though the Australian housing market is moving through an inflection point, with our combined capital city index recording a 1.5% fall over the month and a 0.5% over the 3 months ending November. The fall in dwelling values across the combined capitals was broad-based, with 5 of Australia's 8 capital cities recording a negative result over the month. The Melbourne index showed the largest fall, down by 3.5%, while Sydney values were down by 1.4%. Falls were also recorded in Hobart, Canberra and Darwin, while dwelling values showed a subtle rise in Adelaide, Brisbane and Perth. The latest housing market figures have seen the rolling quarterly rate of change slip to negative 0.5%, which is the largest fall over a 3-month period in almost 3 years. The annual rate of growth has slipped from a recent high of 11.1%, which was recorded over the 12 months ending July earlier this year, to 8.7% over the 12 months to the end of November. The only cities where dwelling values are down on an annual basis are Darwin and Perth, where values peaked much earlier due to softer economic conditions and a wind down in migration rates. Since values peaked in Perth in December last year, dwelling values are now down by 5.9%, while in Darwin, where the market peaked back in May 2014, values have fallen by a total of 6.8%. Sydney and Melbourne have been the standout cities for value growth over the past year, and for that matter over the past cycle to date and the previous cycle, although the rate of value growth in each city now appears to be slowing. Both cities have recorded a fall in home values over the past 3 months, down 1% and 0.5% respectively. Despite the recent weakness, Sydney and Melbourne have recorded much stronger value growth over the past year than all other capital cities, with values 12.8% and 11.8% higher. Brisbane and Canberra were the only other capital cities to record an annual value growth of at least 4% over the past year. Across the remaining capital cities, the annual change in home values was recorded at 3.3% in Adelaide, a 4.1% drop in Perth, Hobart values were up by 1.1% and Darwin saw a 4.2% drop in values. The slowdown in Sydney and Melbourne housing market conditions has been foreshadowed by lower auction clearance rates. Sydney's auction clearance rates are now below 60% and have been throughout November, after peaking at 90% over the first week of April, while in Melbourne clearance rates have shown more resilience but have remained under 70% since the end of October. In a reflection of softer vendor confidence, the spring listing trend has been relatively subdued compared with the previous spring season, with the only cities to show the number of newly advertised properties higher than a year ago being Melbourne, Adelaide and Canberra. New listing numbers have tracked lower than a year ago in the remaining capital cities. In Perth and Darwin, where housing market conditions have been the weakest, total listing numbers have been trending higher at a time when new listing numbers are trending lower, highlighting a slow rate of stock absorption in these markets. Recently, Sydney started to show a similar trend, with total listing numbers now 4.3% higher than a year ago. Despite the slowdown in capital gains, Sydney and Melbourne are still experiencing a fairly rapid rate of sale, although the average number of days it takes to sell a property has increased slightly over the past few months. The typical home in Sydney is now selling after just 29 days, and the typical Melbourne home sells after just 33 days. Despite slight increases, homes in Sydney and Melbourne are still selling much quicker than homes in other capital cities. Across the other capital cities, the average days on markets recorded at 52 days in Brisbane, 48 days in Adelaide, 60 days in Perth, 44 days in Hobart, 97 days in Darwin and 42 days in Canberra. Let's have a look at the housing markets across each of the capital cities. The rate of capital growth in Sydney's cooled, with values falling by 1.4% in November, which is the largest month-on-month fall in 5 years. Sydney dwelling values have shifted 1% lower over the past 3 months. Despite the slowing rate of growth, Sydney home values have still increased by 12.8% over the past year. That's the highest annual rate of capital growth across Australia's capital cities. House values have increased by 13.2% over the past year, compared with an 11.1% rise in unit values. While home values continue to increase on an annual basis, the rate of rental change is substantially lower, with weekly rents having increased by just 2% over the past year. As a result, gross rental yields are amongst the lowest of all capital cities. The typical Sydney house is showing a gross yield of 3.2% and unit yields are averaging 4.1%, with readings only slightly above record lows. Home values in Melbourne fell by 3.5% in November, and they were 0.5% lower over the past 3 months. Although values have fallen recently, they're still 11.8% higher over the past year. The annual rate of growth has slipped lower over the recent months' decline. However, Melbourne's recorded the second highest level of capital gain over the past 12 months. House values are increasing at a much faster pace than unit values. Over the past year, house values have increased by 12.9% relative to a comparatively low 2.9% rise in unit values. The annual increase in home values is substantially greater than rental growth, which in turn has pushed yields to record low levels, although there's been a slight increase in Melbourne's yields over the past month. Over the year, house rents have increased by 2.1% and unit rents are 2% higher. House yields are at a gross rate of 3%, while unit yields sit at 4.2%. Brisbane home values increased by 0.6% in November, and they're 1.8% higher over the 3 months to November. Despite the recent increases, home values are up by a modest 4% over the past year. The annual change in values is much lower than those in Sydney and Melbourne, but also has the advantage of being a much more sustainable pace of capital growth. House values have increased by 4.4% over the past year, while unit values have actually fallen by 0.3%. Rental rates have also fallen over the past year, with house rents down by 0.2% and unit rents falling by 0.6%. With value rises outpacing rental change, rental yields have also trended moderately lower over the past year, although Brisbane yields remain substantially higher compared to Sydney and Melbourne. Gross house yields are recorded at 4.3% and unit yields are currently recorded at 5.3%. Home values in Adelaide have increased by 0.7% in November to be 1% higher over the past 3 months and 3.3% higher over the past 12 months. Over the last 12 months, Adelaide house values have increased by 3.4%, while unit values have increased by 2.3%. Rental rates have barely moved over the past year, with house rents increasing by 0.3% compared to a 0.5% fall in unit values. Although value and rental growth has been quite low over the year, gross rental yields have been pushed lower in Adelaide. Gross rental yields for houses are currently averaging 4.1%, and for units, yields are currently at 4.7%. While the trend in Perth home values is negative, home values actually rose by 0.3% in the month of November. Dwelling values across Perth have fallen by 1.9% over the past 3 months and are 4.1% lower over the past year. The 4.1% annual fall in values is the largest decline in Perth's housing market since February 2012, with house values showing a more substantial decline compared with unit values at 4.2% down compared with 3.6% of the unit market. While home values are falling, rents are falling at a faster pace, down by 7.4% for houses over the past 12 months and by 8.3% for units. The large falls in rents are pushing gross rental yields lower to 3.9% for houses and 4.4% for units. Home values in Hobart fell by 2.4% in November, and they're 2.9% lower over the past 3 months. Over the past year, home values have actually increased by 1.1%, with unit values recording a greater increase of 7.2% than house values, which were up 0.5%. Hobart's recorded only moderate rental increases over the past year, with house rents up 3% and unit rents rising by 0.3%. Gross rental yields in the Hobart market are amongst the highest of any capital city, with the average gross yield in Hobart houses unchanged over the year at 5.4%, while unit yields have fallen to 5.4% over the year. Home values in Darwin are continuing to correct, with values falling by 4.2% over the past year, with a 1.3% fall over the past month, and values are down 1.7% over the past 3 months. Unit values are experiencing a much greater fall over the year compared with houses, with unit values down by 6.1% compared with a 3.6% fall in house values. Relative to the fall in rents, depreciation in home values has been moderate over the past year. House rents have fallen by 13.7% over the past 12 months, and unit rents are down by 12.3%. As a consequence of the sharp fall in rents, yields are being pushed much lower for houses and now sit at 5.3%, while for units they're recorded at 5.5%. Despite the lower yield scenario, Darwin remains one of the highest yielding capital cities. Canberra's housing market is showing moderate levels of value growth, with values falling by 0.5% over the month, but they're actually up by 2% over the past 3 months, and they're 4.5% higher over the past year. Canberra's improved rate of capital gain over the past 12 months can be entirely attributed to an increase in house values, which are up by 5%, while unit values have fallen by 1.1%. Rental rates have also recorded some moderate increases over the year. House rents have increased by 1.1% over the year, and unit rents are up by 0.8%. House yields have fallen over the year from 4.2% down to 4.1%, while unit yields have increased from 5% a year ago to 5.1% currently. There are several factors at play conspiring to slow down housing market conditions. The first is changed lending conditions. Many lenders are now placing a premium of approximately 30 basis points on investment mortgage rates. Additionally, mortgage rates have been lifted independently of the Reserve Bank cash rate in response to higher capital requirements from APRA, and serviceability limits have also been tightened, meaning borrowers may need larger deposits. Affordability constraints are also likely blocking some segments from participating in the housing market. With dwelling values increasing at a much faster pace than household incomes, particularly in Sydney and Melbourne, some prospective buyers simply don't have the budgets to fund mortgage payments despite the low interest rate setting. Another disincentive for buyers is the low rental yield environment. Gross yields moved slightly higher in November but remain close to record lows. While the yield scenario is most relevant to investors, a low yield also implies the costs of renting compared with buying are out of balance. With 2016 just around the corner, the housing market's likely to remain busy over the first half of December. However, activity is likely to settle down a week out from Christmas and into the New Year festive period. We don't expect auction markets to show a substantial increase in volumes until the first week of February. While we don't anticipate a sharp or significant fall in dwelling values, if the recent trends in the housing market conditions are anything to go by, we may see some further negative movements as the market moves out of what's been a very strong and long growth phase. As a refresher, the most recent downturn in the housing market ran for 19 months, from October 2010 through to May 2012, and dwelling values fell by 6.9%. Prior to that, dwelling values fell in 2008 by 6.1%. The Reserve Bank and financial regulators are likely to be keeping a close eye on the housing market. A less buoyant housing market is likely to provide the Reserve Bank with a greater degree of flexibility in adjusting interest rates with less risk of overstimulating the housing market compared with a few months ago. While the Reserve Bank is likely to welcome a slowdown in the rate of home value appreciation, the overriding objective would be to avoid a significant downturn in the housing market, which would act as a weight on economic growth and potentially impact financial system stability. As always, thanks for tuning in to our monthly housing market update. If you'd like to stay up to date with your local housing market conditions, check out our research blog, which is updated regularly at www.corelogic.com.au. Additionally, detailed housing reports are also available at propertyvalue.com.au.